This is InvestTalk. Independent thinking, shared success.
Hey, Justin and/or Luke. This is Dan from Walnut Creek, and I have a question on Under Armour, UAA. I have this in my account where I buy some beaten down stocks that I think companies that might bounce back. And they've been doing pretty good, but since about the middle of December, it's been in a downtrend. And I was wondering what your guys' thoughts were on this stock. Thank you.
All right, looking at Under Armour, and frankly, this stock has been in a downtrend well below December. It peaked back in 2015 at about $50 per share. Now it's down to $7.28. And it's had some nice rallies throughout that time. You had it bottom in 2017 around $12, rallied all the way up to 26, right? More than doubled, and then rolled back over. Hit a low around $7 and change, rallied all the way up to about $25. Tripled. What'd it do? Rolled back over, and it's been hanging around the $6 to $10 range ever since basically 2022. And now it's at $7 and change. So kind of near the low end of its range. Technically, that is bearish. Don't like that. You look at the profitability, return equity is negative, return on invested capital is negative. Now, the good thing is they don't have a lot of net debt in their balance sheet, but their free cash flow is negative $153 million. And it's very up and down. It was negative in 2023, then went positive last year. And then by the end of last year, went negative once again. So, it's all over the board. Earnings for this year expected to be 31 cents. That's down 44% from the 55 cents it earned last year. And then it's supposed to earn 40 cents next year. Not great. Not a great track record here. The really only big win has been Steph Curry. They haven't really been able to replicate the success of Steph Curry. And Steph Curry is an anomaly. He's he's probably a top 10 player of all time. And they got lucky, and Nico Harrison screwed up the pitch for Steph Curry. I think that was what he messed up. And he ended up going with Under Armour instead of Nike. So in some ways they got lucky here. And historically, this has been a poorly run business. It was a flash in the pan, and they haven't been able to get off the mat and create a sustainable business, a sustainable brand. And you have other newer brands that are coming up like On Running, Hoka, etc., really taking the mantle and stealing market share from Nike as well as Under Armour here. So I think it's rolling over for a good reason. I don't think this has, unless there's some big management shift or they sign another huge athlete that's generational like Steph Curry, I just don't see this getting off the mat. So I'm going to pass on Under Armour. I think you should move on. I think there are other brands. I'd much rather own a Nike, which has much, a broader business, has better long-term brand equity, etc. And I'd rather own that than this. And so if you're going to go with a beaten down apparel name, I think there's just better options out there than Under Armour. So I would sell it. Thanks for the call. Let's keep things moving. Get to a fresh question from the comments section over on our YouTube channel. And Iraq Dawn 1964 says, "Hi, longtime listener, and try to listen every day. FNV, you were recommending a few months back, and I picked up some. It has done pretty well, but I'm wondering at what level should I start getting out? It seems to be able to hit about 155, 160 before it normally corrects. Thank you." All right. So here's the way you have to think about this is, what is your time horizon? Is this a trade for you, or is this a long-term role? We've held FNV for a long period of time. It's one of our favorite ways to get exposure to the gold mining space. Why? Because they're not a typical gold miner. They go and invest, and they help finance the mines, the production of those mines by the major gold producers, and they get streaming rights from those interests. So every ounce that's pulled out of the ground, they get a piece of that. And so it allows their revenue to be diversified, and they tend to be long-term more profitable than most miners that are out there. So that's why we tend to like the streaming companies like a Franco-Nevada FNV. Now, this has rallied with the mining space overall, and they did have some issues with one of their mines in Central America, but they're looking to resolve that. And so that caused the stock to slide back in the early part of last year, but it's been recovering nicely. And we think there's more upside here to come because of the quality of the business and the fact that, gold prices are now at new, fresh, all-time highs. And a $27 billion market cap. Earnings this year are supposed to be an all-time high of $4.07, up 32% year over year. So, is it getting into some resistance levels here around, the 140s? Yeah, it is to a degree. It probably is a bit overbought. But the question, once again, as I said at the beginning, was, is this a trade or is this a long-term hold? We are structurally bullish on precious metals in general. Now, it'll go through short-term periods and there'll probably be a pullback in precious metals at some point this year that will shake out the more weak hands. And the question is, are you a weak hand or are you a buy and holder of this particular space? This is a great name to hold if that is true. But if you're just a trader and you're just trying to, ride that quick ride, get the nice returns like you've had over the past month or so, and then move that money to something that, has maybe more upside potential in the short term, then this would be a time to trim. And this goes with everybody out there. When you're looking at a position, you have to ask yourself, what is my time horizon for this? Was this just a trade, or was this something where I love the business, I love the sector, I want this to be a part of the broader allocation of my portfolio? And then you can start to ask the question of whether you should trim, take profits, etc. Thanks for the call. Thanks for the question. Now let's pivot back to the InvestTalk voice bank. You know the number, 888-99-CHART.
Good morning, gentlemen. Thanks for all you do. This is Brett from New Jersey. Giving you a call today about PayPal. I know we've talked about it a lot on the show, but I just want to see kind of where you guys stand on it at this current point. I know earnings didn't look too bad to me, but it took a little bit of a hit. I bought some more of it, and I'm just trying to see what you guys think about it at this point. All right. Thank you very much. Bye-bye.
All right. Looking at PayPal, it's a name we've owned for a little while now, and it did have earnings, and it pulled back. It was overbought. If you pull out to a weekly chart, you definitely saw an overbought scenario that could precipitate some sort of pullback in markets or in this name. And that's what you got on that earnings. Now, let me give you some support levels here. So at $75 is going to be the good support. The great support will be around 70. So, could it chop? Right now it's at 78. Its recent high was around 93. And so, could there be a little more downside in the near term? Sure. But we really still like the name, mainly because of that free cash flow. Trailing 12 months, $6.7 billion in free cash flow on a $75 billion enterprise value. It's about an 8% free cash flow yield. Growth did slow a little bit, but overall, like you said, I think the earnings were pretty good. We were fine with it. And we do think this is a good time to start buying in on this pullback. Thanks for the call. For in-depth market analysis and stock ideas, subscribe to the KPP Premium Newsletter today.
Hi, this is a long-time listener to the show from the Midwest here. Love the show. Thank you guys for all the education you provide us. Luke, Justin, I hope you're having a great day. I hear you guys talking a lot that the industrial sector is a good one to get into. I don't know of a specific stock myself and probably wouldn't have the time to keep up on it, so I'm looking at ETFs and mutual funds. I've narrowed it down to a couple, XLI, which I hear of a lot, and I've also found VIS. I was wondering if either one of these, if one would be a little better than the other, or if it doesn't matter too much on which one I select. Thank you, and I look forward to hearing your thoughts and opinion of these on the show. Have a great day.
All right, well, great question, and I like that you are admitting you don't have the time to investigate individual stocks, and you just want broad-based exposure here to these sectors or this sector. And I agree. We like the industrial sector overall, kind of some secular tailwinds here. But you're looking at two different ones. XLI, this is the Industrial Select Sector Spider ETF, as well as VIS, which is the Vanguard Industrial ETF, and they have similar cost. You're talking about 8 basis points net expense ratio on XLI and 9 basis points on VIS. Okay. So really negligible, 1 basis point difference wouldn't change my discussion of which one I'd rather buy. Then you dig into the holdings, and obviously they're both holding pretty much all industrial names. But then if I look at some of the metrics, and it gets pretty interesting. On VIS, the P ratio is about 21 versus about 23, a little over 23.2 on XLI. And then I look at things like price to book. You have 4.3 on VIS versus 5.3 on XLI. Price to sales, 1.9 on VIS and 2.4 on XLI. VIS skews a little smaller, a little closer to the mid-cap space, whereas XLI is closer to the large cap space. And you look at things like cash flow growth is much better on VIS. So I'm looking at these metrics, and overall, I actually like the portfolio of VIS just a bit better. Yeah, it's 1 basis point more expensive, but that doesn't change my analysis here. So if I'm going to buy one of these two, if I want exposure to industrials, I would go with VIS, the Vanguard Industrial ETF. Okay, thanks for the call. Now, before I get into our next topic, let's touch on another question submitted via our YouTube channel. Nicholas Collins says, I have a question about gold. However, gold can be described as a hedge against inflation, less volatile with less risk, and a great way to diversify. It seems that over the years, gold has outperformed the S&P 500. I was always told that on average, stocks will have higher gains over the long term, but will be more volatile, but that doesn't seem to be the case. Is there something I'm missing? Also, if I were to add gold to my portfolio, would this be a good time to buy? And what type would be best? Gold miners, solid gold, etc. This is a great question. Now, if you go, it depends on what time frame you're talking about. Okay, if you talk about 2000 on till today, gold has outperformed stocks. But you're kind of cherry picking the top in markets. The top in March of 2000, so you're picking a bad time to buy equities. And so, and gold at that time was very, very low. I think it was like $200-$300 an ounce. And so it's done much better than equities since 2000. But if you just set that date back to like 95, or even go back to the secular bottom in equities in the early 80s, equities have outperformed gold. So it kind of depends on your time frame. Now, you're correct. It is a good inflation hedge, the portfolio diversifier. That's certainly true. But there are some nice tailwinds right now, and it's really geopolitically. You've seen with us confiscating the assets of Russia. We're kind of in this fourth turning type of environment where things are changing. You obviously have wars in the Middle East still, in Eastern Europe. And all this means that there's a flight to safety. There's a lot of buying coming out of China as the housing market there is becoming more and more uninvestable. And there's just a lot of nice tailwinds to the gold price. So I would use it once again as a portfolio diversifier. You should have good exposure there. Now, is this the perfect time? No, I mean, the market's rallied. You'd rather have a little bit sentiment to be a little bit more negative, but I wouldn't get too choosy, especially if you don't have much gold allocation, right? Because I could see gold going from here at 2,900 ounce all the way up to 3,500. And then you have a 15-20% pullback in gold, and you're just back to, kind of where you are now, or maybe a little higher in the next down move, right? So it kind of depends on where gold peaks out in this current cycle. Right now, it's in a bull cycle. So I would be buying on dips. And now, which type is the best? Well, the question is, how much risk do you want to take? Gold miners are historically riskier, but if we do get a boom in gold prices, their earnings are going to go up dramatically. There's what are called operating leverage with gold miners. And so that's why we tend to like those. A lot of them pay dividends as well. But you have to find ones that have good quality mines, good jurisdictions, good leadership, et cetera. And that can be more of a challenge. Now, you could buy like a broad-based ETF like this one, that one caller was asking about industrials. That could be a good way of going about it as well if you don't want to investigate individual names. So you could go do that. I think physical gold, I don't mind it. I just think it's a little bit of overkill. I don't think that the financial system is going to if the financial system collapses and you can't get your gold from your GLD or whatever, I don't think that I think you have other problems to worry about. And so I don't think you're going to get into that type of situation, having a little bit of physical gold, fine. I have no problem with it, but I don't think that is necessarily the way you should be gaining exposure to gold. So you could buy GLD or IAU, one of those gold ETFs that follow the price of gold. That would be a little bit lower risk than buying gold miners, but just kind of depends on your risk tolerance level. And here's another cute example or cute idea: buy a little of each. Diversify your diversifier. Okay. Thanks for the call. Or thanks for the question. Now let's talk about sports betting. Sports betting. We just had the Super Bowl. A lot of people put money on the Super Bowl. I actually know a few people that made some money on the Super Bowl. So they did well. But there's a new study by Stanford University that looked at 444 sports bettors. And they did a few things. They asked them to recall their winnings, how well they did over the past few months. And they asked to predict their future results of how they're going to do going forward. And what these participants did is they allowed Stanford to see the results of their actual betting account. So seeing the raw data and then polling them on how they thought they did and how they're likely to do in the future. What did they find? 10% of bettors were overly optimistic by a dramatic amount, 20% or more, to what the reality was. And 80% were also overly optimistic, now to a much smaller degree, but still overly optimistic. And it showed that customers expect a gain of 0.3 cents for every dollar wagered. So expected to make 30% on whatever they're wagering. But the reality is they actually lost 7.5 cents per dollar. Okay. 7.5 cents per dollar. That's a big loss. 9% of bettors actually underestimated their actual future returns. So they were more pessimistic than reality. But what's interesting here is that even though a lot of these bettors were losing money, they still were very optimistic that they were going to continue, they were going to turn it around and make money in the future. And the ones that were the most wildly overly optimistic, the ones that bet on parlays, where you bet, right? You bet multiple things are going to happen for a big payoff. And 32% of these participants mostly wagered on parlays. Now, 20% of them thought that they were betting too much. But that's only 20%, when the vast majority of them were losing money. And so I wanted to highlight this, because of the Super Bowl yesterday. I think it's one of the biggest sporting events that people bet on each year. But it just shows you how detrimental typically betting is to your health, your financial health. So it's important to follow the numbers. It can be fun here or there. I don't think anybody should say never bet. Hey, if you want to throw some money here or there. But serial bettors, they lose money. Simple as that. It's like when you go to the casino, right? The longer you sit there at the table, the better your odds are that you're going to run out of money. Because guess what? The casino never runs out of money. And that's no different with sports betting, even though it's more widespread and easier to bet these days. Let's go take a live call. James from New York asking about Nike, and he listens to us on the podcast.
Yeah, good evening. Looking at Nike, I don't know if you feel maybe this could get a little bit cheaper before I enter a position. It's been on my watch list, but I know it's dropped a healthy amount, but could this get cheaper, and is there a better entry point?
Well, the simple answer is, can it get cheaper? Absolutely. Absolutely it can get cheaper, but you're right near a 52-week low in the low 70s. The monthly chart 200 month moving average is right around $65 per share. That would also be support. So, could it get down into the mid 60s? Sure, potentially, but you're getting, pretty cheap here. Now, a lot still depends on the ability for Nike to really turn it around, the new CEO to, to really adjust their strategy to bring their brand back to life. I think there's still plenty in the brand. It just takes, frankly, a new way of looking at how to resonate with athletes, with consumers. And unfortunately, it was one of those other companies where they hired some big shot guy from a consultancy and ran it into the ground because it just looked at the raw numbers. They pulled out a Foot Locker, for example, and did a lot of dumb things that really hurt the brand overall. And, to me, these are buying opportunities because I don't think the brand is dead in any way, shape, or form. I still think there's a lot of value there. But it may take longer than the market really wants for, the numbers to turn around in a big, big way. So I still think that it's a good value down here. Could it get cheaper? Yes, there's another big support level around 65, and it could absolutely get there. But I think you're getting pretty close to that bottom. Where exactly that is, it's hard to know. But still a fan of Nike down at these levels. Now, we've got time, so let's fit in another listener question from our InvestTalk YouTube channel. And Stock Dog in the Philippines says, I'm liking a spike in the VIX. I traded an income ETF called YMAG during pullbacks. Spikes in the VIX by using limit orders to sell out of the money puts. What's your opinion on YMAG and my strategy? Well, not too clear exactly what your strategy is. Are you selling out of the money puts on YMAG? I'm thinking. So this is the Yield Max Magnificent Sevens of Options Income. So what it looks like, let me look at the portfolio. I'm assuming they just own the Mag 7. Oh, okay. So it owns the Yield Max ETFs of the Mag 7, Meta, Apple, Amazon, Google, Microsoft, Tesla, NVIDIA. Okay. And they spread it out roughly 15% each position. And they're, it's trying to produce income here. These are one of those covered call ETFs. And I think, unfortunately, it's become a popular type of strategy without understanding that it's about the underlying positions. And, the expense ratio is 1.28%, very, very high. So it's very expensive. Don't like that. And then if you look at the performance, it's going to look similar to the Mag 7, except it's going to, it's selling options and it's going to hedge on the downside, but it's going to take away a lot of the gain on the upside. So is this going to outperform the Mag 7? Well, it will if the Mag 7 goes down, which it kind of struggled this year. This ETF is down over 1% on the year. I haven't looked at what the Mag 7 itself is doing. I don't have that ETF or index in front of me, but I'm not a fan of this. First off, Mag 7 does look a bit tired, and it's all about your allocation. You're allocating to just 7 names, lack of diversity there, all within pretty much the tech or consumer, communications and consumer discretionary sectors, right? So there's no diversity. You're selling options with high, what are called implied volatility. That can be good, but it's not a name I would be buying and holding. You're probably getting sucked in based on the quote unquote yield, but it's about total return here, especially with any of these yield max ETFs. I think they're highly overrated and people get sucked in by what they view as this big return, right? This big dividend. And in one of my other piece of software, it says a 43% yield. This thing has only been out since what? Where are we? Pull up the chart here. It's relatively recent. What's the date on this? Okay, early last year. So it's been about a year. Okay, and it's down on that over the last year. Just not a name I would want to own, honestly. So I don't really like this because I don't like YMAG.
Thanks for being here.
If you found this video valuable, please like it and subscribe to our channel for more insights.
Hi, Justin and Luke. My name is Paul. I'm calling from Dallas, and I have a question on ticker symbol ARDX. That's Ardelyx Incorporated. They're a biopharmaceutical company, and I'm looking to buy in for a small position as a speculative investment. They're a small cap company, and their earnings call is coming up on the 20th of this month. And it looks like they had a strong third quarter, and they're projected to break even soon. So my question is, do you think I should buy in now, just pass on it altogether, or wait for the earnings report? I will listen on the podcast. I love your show. Thank you very much.
All right, looking at ARDX, and this is a biotech company, and they have their own proprietary drug discovery and design platform. And it's as you said, it's a small cap name, about $1.3 billion in market cap, but they're burning cash, and they've burned cash for a long time. They continue to lose money. I don't know where you see that they're going to break even. I see earnings supposed to be negative 17 cents for 2024, and for this year, negative 14 cents. So getting a bit better, but that's also because they're diluting shareholders more, issuing more shares like most biotech companies do. Now their cash burn has gone down, but it's still negative. Negative about $64 million trailing 12 months. Now that's better than the $154 million back in 2021. So things are improving in that way. But once again, they have negative profitability. And to me, this is a buyout play. That's what you're playing here. The history of these biotech names is that they lose money, they will continue to lose money. Yes, earnings and sales are going higher, but once again, they're still losing money, and they typically don't get to profitability. But you could get a situation where some of these pharma names need growth, and they might like their technology, they might like some of their drugs in the pipeline, and they go and buy it. And that's the way I would be looking at this. I wouldn't be buying this for an earnings play or anything like that. Now, could it pop on earnings? Could the good leadership come out and be optimistic about the future of one of their drugs and talk about some trial that got good results or whatever? That's certainly possible, and you could see the stock pop in that way. But if I'm buying this, it's based on that pipeline, it's based on the technology, and it's the play that they will get a buyout. And maybe they do, but maybe that's not for another 2, 3, 4 years. And you get diluted into oblivion. The stock goes down to $1 or $2 and gets bought out for $3. And now it's at $5 and change. And you're still down 50%, even though they bought you out. That happens a lot in the biotech space, especially if you hold them for a long period of time. Now, what I will say is the technicals, they're pretty good. It's a nice little bull flag after a big move back in 2023. It's kind of been consolidating since then. I kind of like the chart a little bit. But overall, I don't like the business. I just don't like biotech names. So it's super high risk. If you want to play it, go for it, but keep your positions pretty small. Thanks for the call. Now let's talk about Treasury issuance. Treasury issuance. I know it's kind of boring, but it's vital to kind of this financial situation that we are in as a country and as a globe, when the world's reserve currency is backed by a government that continues to spend money at an eye-watering pace. And the new Treasury Secretary, Scott Bessent, has talked about that the outgoing Treasury Secretary, Janet Yellen, was ramping up or only issuing short-dated bonds in order to finance the government, and that was juicing the economy. And the reality is that's true. But what's interesting is that the first Treasury refunding announcement that was put out by new Secretary Scott Bessent was doing more of the same, keeping issuance on the short end and not doing a lot of long-dated securities that might push up rates on the long end. Think of the 10-year. That's a proxy for mortgage rates, for example. And so that shows me that this government is going to keep the percentage of T-bill issuance compared to the total stock of debt at relatively elevated levels. Right now, it's at about 22%. And I could easily see this going up to 25%. And so I'll be continuing to watch this to see whether or not we're issuing more of that, what are called duration bonds, or 5, 10 years or so plus. And if we issue a lot more of those, that could pull liquidity out of the system and precipitate a correction in asset prices. They keep it on the short end, that'll keep liquidity moving, at least for the time being. Well, that about does it I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. And if you need help understanding your broader financial situation, building a plan, building a strategy that makes sense for your goals, current market trends, etc., I encourage you to head over to investtalk.com, click on the portfolio review button, and set up a time with me or Luke. Independent thinking, shared success. This is InvestTalk. Good night.